This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. Roger McEowen, K-State and Washburn law professor, starts the show as he talks about potential issues for farmers and ranchers involving trade or business activity, basis, like-kind exchanges, and croppers. K-State's Brady, Brewer, and Briggeman keep the show moving as they discuss the Federal Open Market Committee rate announcement. The pair breaks down what it means and what other factors could be at play. The Beef Cattle Institute's Brad White, Brian Lubbers, and Phillip Lancaster conclude the show conversing about body condition scores for bulls versus cows. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Wednesday show with K-State and Washburn law professor Roger McEowen. Roger, thanks for joining us today.
Good to be with you, Shelby.
Roger, talking through some potential legal and tax issues today, and starting off with a trade or business activity, and what is a trade or business activity?
Well, that's a big issue when it comes to tax because that concept undergirds a lot of things that we deal with in the tax world, and it really matters. And unfortunately, there's confusion sometimes with respect to when an activity rises to the level of a trade or business and what significance that means when it does, or what are the problems that occur when it doesn't, when an activity does not meet the standard of being engaged in as a trade or business activity.
And what are some of the different activities or components that make it a trade or business?
Well, regularity and continuity is the key. Really, it's a fact-based determination. There's not one thing that's key. IRS has tried to argue that over the years, and in fact, it came up with respect to CRP payments a number of years ago, where the government the USDA tried to take the position that once you put your name on a CRP contract, you are engaged in a trade or business activity, and therefore you have self-employment tax on your CRP rents. Well, that's completely ridiculous. That's wrong, because there is a U.S. Supreme Court case on this, which says it's a fact-based analysis. We don't look at a signature on a contract and say that that's conclusive to determine whether the taxpayer is in a trade or business or not. We have to look at all the facts and circumstances. And the case they decided, which gave us that standard, involved a fellow that was gambling, and his primary focus was on greyhound races. And he tried to claim that he was a full-time professional gambler engaged in a trade or business of gambling so that he could deduct fully his losses. Normally, you can't do that for gambling losses, but if you are full-time engaged in that activity on a regular and continuous basis, you can. And he won that case based on, the court said, all the facts and circumstances. So that's the key in determining whether I am engaged in any particular activity as a trade or business. So if your facts don't match up and you don't have a profit intent, then you're probably not going to be deemed to be in a trade or business, which is really going to hurt you if you lose money. You're going to lose the ability to deduct those losses. And, of course, the downside is, as I kind of hinted at, if I am in a trade or business activity, then that's going to go on Schedule F of my farm return, or Schedule C if I'm a non-farmer, and I'll have to pay self-employment tax on that.
Is this a really good time to maybe talk to a professional if it's a little confusing?
Yeah. These issues, you should always have good tax advice.
And when we're thinking about taxes, talking about income tax, and what's the impact of income tax potentially?
Well, income tax basis is really what we focus on in determining tax outcomes in just about every situation. And what basis means is, in essence, what do you have in an item? What's your investment in an item? What do you have in it? And the way to think of basis, I think the easiest way to convey it is, how did I acquire an asset? And if you break it down that way, you can acquire an asset in three ways, essentially. And that would be, I purchased it. Well, my basis in that, what do I have in it? What's my investment in it? That'd be my purchase price. So that establishes my basis. And basis is important to know because then if I sell the asset later on, now let's say it's a business asset, I sell the asset later on, I'm going to have some taxable gain. Well, up to my basis, it's not taxable. If I sell it above my basis, then I've got tax on that difference. And so I need to know what my basis is, because if I can't establish what my basis is, IRS can take me to zero and cause all of that gain to be taxable. We don't want to do that. And there are plenty of cases out there where taxpayer didn't preserve enough records, couldn't substantiate what their basis was, and so the IRS said, well, we're going to assume you have zero basis and all of your gain is taxable. So you want to know what your basis is. So the first way to acquire a basis is maybe you purchased the asset. Another one is maybe you inherited the asset. Well, there's a different rule on basis for an inherited asset, and that is your basis in the asset you inherited is equal to the fair market value of that asset at the time the decedent died. So we call that typically a stepped-up basis, because you get a revaluation of that asset from the time the individual owned it to the time of death. It goes to the value as of date of death. And that can be pretty good in the hands of the recipient, because if they then turn around and sell the asset for its fair market value shortly after the individual died, then there is no taxable gain. You basically sold it for the same amount as what you have as basis in it. Another way to acquire an asset is it could be gifted. Could be gifted to you. Different rule in that situation. In that situation, the recipient of the gifted asset takes the donor's basis in that asset, the person that gifted the asset to them. So if that person has a low basis, I get a low basis. If they had a high basis, I get a high basis. So we need to know what basis is. Basis undergirds many, many tax concepts, and we need to know what that basis is for determining our tax consequences if we dispose of that particular asset.
And with the asset, what happens if improvements or depreciation has taken place with it?
Well, then we get an adjusted basis. And so I have to modify my basis during my period of ownership of a particular asset to reflect improvements to the property, which would increase my basis. Depreciation that's allowed or allowable under the code decreases my basis. So there will be adjustments, and there are other things too, but those are the big ones that cause adjustments to that basis over a period of time. But then if I die owning that asset, then everything steps up to fair market value. We don't worry about all those adjustments. We just revalue it at date of death and we start over again. And that's a very important rule for farmers and ranchers, because there are a lot of low basis assets that farmers have, particularly land that's been held, for example, for decades. Shelby, you might be the favorite great-granddaughter or great-great-granddaughter, and your great-grandfather, let's say, bought a tract of land in 1940. And before he dies, and he knows he's coming down to the end, and you're the favorite great-great-granddaughter, and he wants to see you own that before he passes. And so he's got a deed ready for you. And if he gifts that to you before he dies, you're going to get his 1940 basis in that property, with some adjustments. But basically, you're going to have a low basis. Now, if he were to die and leave it to you, you're going to get a basis equal to 2025 value of that land. So it makes a difference to you, a big difference in these situations. And of course, there's been some legislation talked about in recent years of changing the basis rule at death, not getting a complete stepped-up basis, and that's a really big concern for agriculture.
Is this a time then when we're thinking about all these income tax bases, keeping track of records? Absolutely.
You've got to substantiate your basis, because the burden is on you to establish what your basis is. You have to prove that. And there are a number of cases. We could sit here and talk all day about the cases that are out there where taxpayers have failed to fully substantiate or at all substantiate their basis in property, and we can see the problems they get into. So good record keeping is a must.
And as we're talking about land, like-kind exchange of farmland, and what is that?
Well, that's a rule under 1031 of the Internal Revenue Code that allows me to defer paying tax on transfer of land until I would sell the replacement property I receive in an exchange. So as an alternative to selling land and buying another tract, which would be fully taxable in the year of the sale, what I could do is find somebody that wants to give up a tract. I want to trade that tract for that tract. They want to do the same, so we just swap. There's no tax consequence to that. There can be, But if I'm going bare ground for bare ground and it's of equal value, then there's no tax consequence. Now, if we have unequal values and there's cash boot that's thrown in, then the cash becomes taxable. Or if I'm trading land that I have buildings on, let's say I have a farm building, I have grain bins, I have fences, those types of things, which I've claimed depreciation on, and I exchange that for bare farm ground, then I've got some property that has a depreciation recapture component to it. That's going to be taxable in the year of the trade. The rest will be deferrable. But if I've got depreciation recapture on assets that are involved in the exchange, and that comes up when I'm trading land with improvements on it for bare land, then I can have some tax consequences.
So quite a few little necessities or little factors that go into this then?
Yep. Very complex, yeah.
And just one last thing included in this blog article, what is a cropper?
Well, a cropper is somebody that's to be distinguished from a tenant or an employee. And so a cropper is somebody that comes in and harvests a crop, and you provide the equipment for them. They're just providing their labor, and they harvest the crop for you, and they're paid basically a wage to do that. They're not an employee, but it's a contract-type situation. And so they're not treated as a tenant under tenancy laws. So the farm tenancy laws in Kansas or other states would not apply. They're not entitled to, for example, notice of termination of their tenancy because there is no tenancy. It's just a service. So you'll have a custom cutter would be pretty close to what a cropper is. There's some nuances there, but that's the way you want to think of that. An employee is somebody that works for you is for a W-2 wage, and there are different legal relationships there. And then you have a tenant that is entitled to notice of termination if you want to terminate their lease. So it's just differences in the way the law treats the relationship between somebody that is planting and harvesting a crop based on their status.
Roger, I appreciate you taking the time to join us today.
Thank you, Shelby.
That was K-State and Washburn law professor Roger McEowen. I will link his blog article titled Trade or Business, Income Tax Basis, Cropper, and Like-Kind Exchanges in today's show notes on agtoday.net. We're cutting to a short break now on Agriculture Today, but we'll be right back. You're tuned in to Agriculture Today, and we continue our show with a discussion on the Federal Open Market Committee rate announcement with Brian Briggeman, director of the Arthur Capper Cooperative Center at K-State, and Brady Brewer, K-State Associate Professor in Agricultural Economics. Brian, Brady, thank you both so much for taking the time to join us today.
Thanks, Shelby.
Thank you for having us.
Brady, what was the original plan for 2025 at the end of 2024?
So let's recap where we ended in December of 2024. We had just got done having another 25 basis point decrease of the Fed funds rate, which the Fed funds rate is the overnight rate which the Federal Reserve charges banks across the U.S. for the supply of money. And that's what really sets, or is a large part of what sets interest rate. So we had a 25 basis point or 0.25% decrease at the end of 2024. Coming into January, inflation is moderating. The rate at which it is moderating is slowing down, but there's this expectation that the Fed will continue lowering the Fed funds rate through much of 2025. Maybe not get as much of a decrease as we saw in 2024, but with the lower inflation that we had been seeing, a lot of the markets were predicting lower Fed funds rate here in 2025. We just got done with the March FOMC meeting, the Federal Open Market Committee meeting, and they have chosen to keep interest rates so far through 2025 even. So they have kept the target rate between 4.25% and 4.5%. So we've seen no change so far in 2025 relative to 2024.
So they were planning on making 5 or 6 different interest rate cuts in 2025 as they ended 2024, but now maybe not making that many cuts?
Yeah, so what has changed that has maybe changed expectations for what the FOMC is doing? So first, we've seen this moderation of inflation continue to slow down. If you look at the CPI, which is one of the main indexes that measures what the cost of a basket of goods is, and then the PCE index, which is the personal consumption expenditure index, which is kind of measuring how much money we're just spending as consumers, we've seen them kind of flatten out. So inflation has continued or has stopped marching its way down to the Fed target of 2%. The other thing that has really changed is unemployment has really leveled off. So we've seen an increase in unemployment. The end of 2024, unemployment was steadily increasing. So the number of people that were unemployed and actively searching for jobs was on the rise. However, we've kind of stopped at about 4.1, 4.2%. The Federal Reserve has this dual mandate. They want unemployment around 4.2%, and they want a stable price level of around 2% inflation. So right now, unemployment is right at or even a tick below their target, and inflation is still elevated. So this is what is driving a large part of why we see maybe this change in expectations of we may not get further interest rate or Fed funds decreases for the foreseeable future, at least until the end of 2025. There's some other factors. There's some policy implications, thinking about what may impact future price levels that could be at play here. But as of right now, they seem pretty content at keeping the interest rates stable.
What are some other things that could be at play?
If you look at the FOMC statement, and in particular Chairman Powell, one of the things that he stated is that there's no preset course at the moment. So a lot of the things that Brady outlined as far as the dual mandate, following unemployment, inflation, but there's some other items that the market is talking about you see in financial news, and that centers around uncertainty. There's a lot of questions, a lot of kind of unknowns. Where are we going? What are some of the things that are happening, not just here within the United States, but globally as well? In fact, there's an index that 3 different professors, one from Northwestern, Stanford University, and then University of Chicago, came up with an index called the Global Economic Policy Uncertainty Index. And what it looks at is 3 different components for all countries across the globe, and it weighs it, according to their purchasing power price index. So the United States, for example, would be weighted a little bit more in the index, but it looks at all countries across the world, and it brings in 3 factors that how it's derived. The first of all looks at major news outlets, newspaper sources for those different countries, and it scans the headlines to see if uncertainty or turbulence or volatility, those kind of words are hitting the headlines. And the more that newspapers are reporting that would push the index up. And if they go down to more normal levels, it would fall down. The other part looks at tax policy within those various countries. So it looks in particular at when is tax policy going to expire within 10 years. If there are more tax policies that are going to expire within 10 years, well, that's more uncertainty. Where is the fiscal government in that country going to go? So if there's more of them, that pushes the index up. And then the third and final measure just looks at forecasting surveys. So if we look at forecasting surveys, how much deviation is there, or there's not much agreement among economists of saying where is, the country going, what's the forecast for it? As that variability goes up, well, that pushes the index up too. So that's how the index is created, right? So as it rises, you have more uncertainty. And if we look at it through time, of course, you see through history some real major increases in it. So, for example, 9/11, the 2008 Great Recession, when we had sovereign debt crises in 2012. Remember when Greece are they going to default on their debt? And then, of course, the COVID-19 pandemic was a very high, right? That number shot up across the globe. Well, in January 2025, this index surpassed what happened in the COVID-19 pandemic. And even if you go and these individuals also have a U.S. economic policy index, just focusing on the United States, that uncertainty index is elevated as well. It's not as high as it was in the COVID-19 pandemic, but in January 2025, it is up. So there's uncertainty that's out there, right? That makes, the Fed influences their decision of, well, there's really no preset course right now. We need more information. We need to know where are we heading in the current economic environment.
what does it imply when we have so much uncertainty in the market?
So one way to tie it right back to agriculture goes to the John Deere when they had their earnings call earlier this year, looking at, just orders for machinery and equipment, combines, tractors. It's way down. If you think about with uncertain times, many farmers included making those capital asset purchases, that are going to be used to generate income in the future, you pull back, you wait. And even John Deere making announcements of, well, do we expand different lines? Well, we're going to take a wait and see approach, much like what the Fed is talking about. We need to have more information in order to know where to go with our funds that we have available to invest.
What does waiting and seeing mean for our listeners, Brady?
So we have a lot of uncertainty out there right now. People need to be focusing on what they can control. There's going to be a lot of surprises, both from an economic perspective and a global policy perspective, probably here over the near future. So we need to focus on the stuff we can control. If we can lock in and mitigate other risks, now is the time to do that. The other thing, Brian mentioned pulling back on capital investments. I would encourage all listeners, have a capital spending plan. With this new signal that we're getting from the FOMC that the Fed funds rate may not decrease very much in 2025, if at all, we're not going to see any relief from the interest rate perspective when you go and get a loan at the bank. So that means, we can't stop replacing assets. Stuff breaks down. We need new stuff all the time. So we need to prioritize and figure out what's going to have the biggest impact as we continue to see these elevated prices for the money supply that we are getting.
When will we hear again from the Federal Open Market Committee?
The next time that the Federal Open Market Committee meets will be mid-May, so May 6th and 7th. So that will be the next opportunity we will have to hear from Chairman Powell and get a sense for what the FOMC is going to do moving into the second half of 2025. They always put out a press release that states their what data they were looking at when they made their decisions, and that could be very telling as we're going to have a lot more information in terms of some of these policy outcomes and what that may do to the global economic climate.
The other thing I would probably add for the listeners is just, it's the boring stuff. It's the basics of business, the things that help farmers get through the 1980s farm debt crisis. A lot of those lessons learned still apply today. One thing I would add is just to be as efficient as possible. Brady talked about having a capital spending plan, but I would encourage all the listeners, put together a budget. Have an idea of it. When I put this crop in the ground, when we go out there, well, what are my costs? How much am I going to expect to have on the revenue side? And to realize that first budget you put together is the first wrong budget. You're not going to be right, but have the discipline to go back and take a look so that you can have an idea of, when those opportunities come up, and they will come up, that hopefully then you can start to, build that cash flow, start building from there. But it all starts with some of those, the basics of business and starts with a budget.
Brian, Brady, I appreciate you both taking the time to join us today.
Thanks, Shelby.
Thank you for having us.
That was K-State Associate Professor in Agricultural Economics Brady Brewer and Director of the Arthur Capper Cooperative Center at K-State, Brian Briggeman. We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we conclude our Wednesday show with part of the Beef Cattle Institute's Cattle Chat podcast with Brad White, Brian Lubbers, and Phillip Lancaster.
And Brian, I'm going to let you frame this topic because this is one of the things that you had asked about based on our previous discussions.
Yeah, so this is a listener question from Brian. And we were talking about body condition score a while ago. We were talking, I think it was in relationship to cows and where they were at pre-calving or pre-breeding. And it just kind of got me thinking. So we talk about body condition score, like the scoring system. And I know we use the same point scale for bulls, but clearly there's going to be a difference in point values for a bull versus a cow. So I thought I'd ask Phillip. So kind of what are your thoughts around that, Phillip?
Yeah, we use the same system for all classes of cattle, 1 to 9 scale, and that scale is related to body fat composition, is the main physiological component of that scale. And so as an animal moves from one point on the scale to another, they're either gaining or losing body fat and potentially some muscle mass as well, depending on where they are in the scale. As we get down toward the lower end of the scale, they're losing a lot of that weight loss becomes muscle mass rather than fat, and on the other end of the scale, the weight change is mostly fat and very little muscle. The animal is still going to be the same body composition, but the size of the animal makes a difference. And so a bull is going to be much heavier at his normal body composition, say body condition score 5. And so for him to change from a 5 to a 6 or from a 5 down to a 4, the amount of weight that he's going to gain or lose is much different than a cow because he's so much heavier than a cow.
So what about Brian's question relative to if we used the ultrasound to measure back fat, would that be a better measure of body composition of bulls, or is the body condition score fine?
Well, I think the body condition score is fine. If we're applying it correctly, it should be related to that ultrasound back fat thickness, and so they should be losing a certain amount of back fat as they go from, or gaining back fat as they go from one point on the scale to the other.
Yeah, and a couple reasons this is relevant is we've talked about both yearling bulls that get turned out to pasture will have a different body condition than potentially our mature bulls at the time that they turn out. Not just body weight, but what we care about is that they're in a positive energy balance when they go into the breeding season and maintain all the way through the breeding season. So it's not just the size of the bull, but we actually want them to be continuing to be positive, and that's when we deposit fat, is when we've got a positive energy balance. So is there anything I should think about during the breeding season to kind of ballpark what should I be looking at in those bulls?
You're going to look at the same anatomical points on a bull as you would a cow to evaluate their body condition. You know, across the back, the hooks and pins and the hips, and how many ribs can you see, those types of things. It's just the amount of weight that changes or it takes for them to move a body condition score. And so a rule of thumb, we always kind of use that rule of thumb of 100 pounds. Well, that's more based on the average cow weight. A more precise way to evaluate that is about 7% of their, I'll say, normal weight at a body condition score of 5 is what they should gain or lose when they change let me do the math here real quick in my head. So a 2,000-pound bull going from one body condition score to the other should be losing about 150 pounds. And so that depends on the size of the animal, how much weight it takes to move from one body condition point to the other.
The important part of that is if I've got a cow to gain a body condition, 100 pounds, 2 pounds a day, 50 days. If I've got a bull, I need to plan on a longer time period for him to gain that body condition score. Mm-hmm. So when I'm planning prior to breeding season or during breeding season, that could be important.
That's all we have for you today on Agriculture Today, but we'll be back with more for you tomorrow.